Today, I'm going to look at some of the constraints investors face while investing in Hong Kong. The number of investors in Hong Kong is relatively high, with almost 1.5 million active clients, and almost 40% of them trading or doing margin trading. They have a strong home bias in the sense that they prefer to invest through the Hong Kong Stock Exchange. Only 5% of Hong Kong investors actually invest globally. And also this is primarily in the US markets, where they're familiar with some of the brands and the global technology names traded there. Unfortunately, investing in Hong Kong has been disappointing for a variety of reasons. Firstly, the returns have been very poor. While the Hang Seng has remained in the 24,000 to 26,000 range for the past 10 years, Nasdaq has gone up almost 8 times in the same period. In fact, the Nasdaq has even beaten Hong Kong property prices. Even the slow DAX has doubled in the last 9 years. Going ahead also, we see better opportunities in markets such as China and India rather than in Hong Kong. Secondly, the costs of investing in Hong Kong are relatively high. Finance companies have focused on traditional products such as mutual funds, which offer exceedingly high fees and distributor margins. Hong Kong MPF is one of the most expensive in the world. While fees have declined over the last 10 years, they still remain over 1.5%, one of the highest in the world. Local brokers have been hesitant to adopt new technologies, which could have improved onboarding processes and reduced brokerage costs, such as elsewhere in the world. Even the securities transaction tax levied by the government in Hong Kong is one of the highest in the world. Hong Kong has also seen less fintech disruption or digital absorption than many other markets. Even if you compare it with Singapore, you can see that there are 6 robo-advisors in Singapore compared to only 2 in Hong Kong. Even the number of clients using robo-advisory services is only a fraction of those in Singapore. Even virtual banks have been slow to take off so far in Hong Kong. The Stock Exchange of Hong Kong has a very good track record when it comes to trading volumes and new IPOs. It topped the global rankings for IPO markets again in 2019, the 7th time in 11 years, with blockbuster IPOs such as Alibaba and Budweiser. However, it has lagged in financial innovation. Morningstar rated the Hong Kong market as below average in terms of its development. There are very limited choice of instruments, whether it be ETFs or REITs or even trading simple corporate bonds. In order to create an efficient portfolio, the Kristal.AI algorithm needs cost-effective and diversified ETFs. We need both fixed income and equity investments, and also in small sizes so that we can make them available to smaller investors. This is just not possible to do in Hong Kong. Local Hong Kong dollar ETFs have minimum lot sizes and are limited in number and liquidity. It's easier to trade US listed ETFs such as MCHI or CNYA, even when looking to invest in Hong Kong and China markets. The coronavirus will have a big impact on the industry. Investors who've been stuck at home have had a chance to relook at their portfolio strategies, as well as evaluate different online alternatives. Kristal.AI and other online brokers have seen a huge surge in demand. At the same time, 100 members of the Hong Kong Securities Association are facing a severe crisis, and almost 15 of them have closed in 2020. This is as per Gordon Sui, the chairman of the association. We advise Hong Kong clients to avoid concentrating all their investments in Hong Kong and look at diversifying into global markets. Don't keep all your eggs in the same basket. If Hong Kong does badly, your investments and your job prospects will decline at the same time. So check out our algo and see what it has to suggest in terms of your portfolio allocation. Thank you.